Hey guys, welcome back to our channel. Today, I wanted to do something a little bit different and kind of start a new series on the channel. So today, I would like to be reading to you guys about investing. And investing is really important because it can help you earn money. However, you have to do it wisely because you could also lose money. So the website I will be reading off of is themotleyfool.com. It's really good, and I think it has a lot of good resources. So, how to get to the story that I will be reading is if you go to their homepage and then you go to, at the top of the page, you go to Investing Basics, and then underneath that is Investing 101, and you click the first link. So, the first story is How to Invest Money Getting Started with Investing by Matthew Frankel. First of all, congratulations. Investing your money can be an extremely reliable way to build wealth over time. If you're a first-time investor, we're here to help you get started. It's time to make your money work for you. Before you put your money into stock market or other investments, you'll need a basic understanding of how to invest your money the right way. Unfortunately, there's no one-size-fits-all answer here. The best way to invest your money is whichever way works best for you. To figure that out, you want to consider your investing style, your budget, and your risk tolerance. Number one, your style. How much time do you want to put into your investing your money? The investing world has two major camps when it comes to ways to invest money: active investing and passive investing. Both can be great ways to build wealth, as long as you focus on the long term and aren't just looking for short-term gains, but your lifestyle, budget, risk tolerance, and interest might give you a preference for one type. Active investing. We'll start with active investing. Active investing means taking time to reach investments yourself and constructing and maintaining your portfolio on your own. In simple terms, if you plan to buy and sell individual stocks through the online broker, you're planning to be an active investor. To successfully be an active investor, you'll need three things. Number one, time. Active investing requires lots of homework. You'll need to research stocks. You'll also need to perform some basic investment analysis and keep up with your investments after you buy them. Knowledge. All the time in the world won't help you if you don't know how to analyze investments and properly research stocks. You should at least be familiar with some of the basics of how to analyze stocks before you invest in them. Desire. Many people simply don't want to spend hours on their investments, and since passive investments have historically produced strong returns, there's absolutely nothing wrong with this approach. As Warren Buffett has said regarding passive investing, it's not necessary to do extraordinary things to get extraordinary results. Active investing certainly has the potential for superior returns, but you'd have to want to spend the time to get it right. Passive investing. On the other hand, passive investing is the equivalent of the airplane on autopilot as compared to the flying manually. You'll still get good results over the long run, and the effort required is far less. In a nutshell, passive investing involves putting your money to work in investment vehicles where someone else is doing the hard work. Mutual fund investing is a good example of this strategy. Or you could use a hybrid approach. For example, you could hire a financial or investment advisor, or use a robo-advisor to construct and implement an investment strategy on your behalf. Number two, your budget. How much money do you have to invest? You may think you need a large sum of money to start a portfolio, but you can begin investing with $100. we also have great ideas for investing $1,000. Here's a point. The amount of money you're starting with isn't the most important thing. Instead, the big question is whether you're financially ready to invest and to invest frequently over time. One important step to take before investing is to establish an emergency fund. This is cash set aside in a form that makes it available for quick withdrawal, such as savings account. Most investments, whether stocks, mutual funds, or real estate, have some level of risk. You never want to find yourself forced to divest or sell these investments at the time of need. The emergency fund is your safety net to avoid this. Most financial planners suggest an ideal amount for the emergency fund is enough to cover 6 months' worth of expenses. While this is certainly a good target, you don't need this much set aside before you can invest. The point is that you just don't want to have to sell your investments every time you get a flat tire or have some other unforeseen expense pop up. It's also a smart idea to get rid of any high interest debt before starting to invest. Think of it this way. The stock market has historically produced returns of 9% to 10% annually over long periods. If you invest your money at these types of returns and simultaneously pay a 24% APR, or the average in mind 2023, to your creditors, you're putting yourself in a position to lose money over the long run. Number 3, risk tolerance. How much financial risk are you willing to take? Not all investments are successful. Each type of investment has its own level of risk, but this risk is often correlated with returns. It's important to find a balance between maximizing the returns on your money and finding a comfortable risk level. For example, high-quality bonds, such as treasury bonds, offer predictable returns with very low risk, but there are also yield relatively low returns, around 4% to 6% by contrast. Stock returns can vary widely depending on the company and time frame. However, the overall stock market has historically produced average returns of almost 10% per year. Even within the broad categories of stocks and bonds, there can be huge differences in risk. For example, a treasury bond or AAA-rated corporate bond is a very low-risk investment. However, these will likely pay relatively low interest rates. Saving accounts represent an even lower risk, but offer a lower reward. On the other hand, a high-yield bond can produce greater income, but will come with a greater risk default. In the world of stocks, the spectrum of risk between blue chip stocks like Apple and penny stocks is enormous. One good solution for beginners is using a robo-advisor to formulate an investment plan that meets your risk tolerance and financial goals. In a nutshell, a robo-advisor is a service offered by a brokerage. It will construct and maintain a portfolio of stock and bond-based index funds designed to maximize your return potential while keeping your risk level appropriate for your needs. What should you invest your money in? Here's a tough question, and unfortunately, there is no perfect answer. The best type of investment depends on your investment goals. But based on your guidelines discussed above, you should be in far better position to decide what you should invest in. For example, if you have a relatively high risk tolerance as well as the time and desire to research individual stocks, that could be the best way to go. If you have a low risk tolerance but want a higher returns than you'd get from a savings account, bond investments, or bond funds might be more appropriate. If you're like most Americans and don't want to spend hours of your time on your portfolio, putting your money in passive investments like index funds or mutual funds can be the smart choice. And if you really want to take a hands-off approach, the robo-advisor could be right for you.